All right, let's dive into Accounting 101 today. Get ready for financial statements, journal entries, all that fun stuff, and especially for all you students out there, we're going to help you ace those exams with this deep dive into some amazing materials from Grade Guru.
Absolutely. We'll break down those tricky concepts, give you some real-world examples, and by the end of this, you'll be talking accounting like a pro.
Sounds good to me. Where do we even start with accounting? It can feel pretty overwhelming.
It all starts with the foundation, the bedrock of accounting. The accounting equation. It's simple but powerful. Ready for it?
Hit me with it.
Assets equal liabilities plus stockholders' equity. Pretty straightforward, right?
Yeah, it seems pretty simple on the surface,
Yeah,
but I bet there's more to it. Can you break it down?
absolutely. Think of it this way. A company has stuff it owns, right? Those are its assets. Cash, buildings, equipment, even patents and trademarks. All valuable resources they use.
Okay, so assets are what a company owns. What about liabilities? How do those fit in?
Liabilities are what a company owes to others. Those obligations they need to settle, usually with cash or other assets. Loans, unpaid bills, salaries, that kind of thing.
So assets are what we own, liabilities are what we owe. What about that last piece, stockholders' equity?
Stockholders' equity is the owner's stake in the company. It's what's left of the company's assets after you subtract all the liabilities, the portion that belongs to the owners after all the debts are paid.
So you take everything a company owns, its assets, and subtract everything they owe, their liabilities, and you're left with what belongs to the owners, stockholders' equity. Like solving a puzzle.
Exactly. And the beauty is the accounting equation always holds true. It's the fundamental principle that governs all those accounting transactions.
This is starting to make sense. Grade Guru even gave a practical example. They showed how a company with assets worth 10,000 euro and liabilities of 4,000 would have stockholders' equity of 6,000.
Perfect illustration. That's how the accounting equation works. This simple relationship between assets, liabilities, and equity, well, it's the foundation for everything we do in accounting, even preparing financial statements.
Speaking of financial statements, those are a big part of any accounting course and probably a major focus on those exams. What do we need to know about them?
Absolutely. Financial statements are how companies communicate their financial info to the outside world. There are four main ones we'll dive into: the income statement, the balance sheet, the statement of cash flows, and the statement of retained earnings.
Okay, 4 financial statements.
Yeah.
Sounds a little intimidating, but I'm ready to tackle them one by one. Let's start with the income statement. What's its main purpose?
The income statement, sometimes called the profit and loss statement, tells us how much profit a company made or lost over a specific time, like a month, a quarter, or a year. It's basically a report card on the company's performance.
So it's all about measuring profitability. How do companies actually calculate their profit or loss?
It comes down to revenues and expenses. Revenues are the inflows of assets a company earns from its main operations, like selling goods or services.
Because for a bakery, revenue would be all the money they make selling bread and pastries.
Exactly. Expenses, on the other hand, are the outflows or using up of assets a company needs to generate those revenues. Cost of ingredients, rent for the bakery, employee wages, even advertising costs.
So it's all about the money coming in, the revenues, and the money going out, the expenses. What's the formula to figure out the profit?
It's pretty straightforward. Net income equals revenues minus expenses. If revenues are higher than expenses, they've made a profit, also called net income. If expenses are higher, then they've incurred a loss or a net loss.
Grade Guru has a helpful example here. They show a company with revenues of $400,000 and expenses of $320,800 profit. Ends up with a net income of $79,200. Pretty decent profit.
It is, and that's how the income statement gives a clear picture of a company's financial performance over a specific period. It tells us if they're making money, losing money, and by how much.
Okay, starting to get a feel for the income statement. What about the next one, the balance sheet? How is it different from the income statement?
Think of the balance sheet like a snapshot of a company's financial position at a specific moment in time, like a photograph of the company's assets, liabilities, and equity.
Ah, so the income statement shows performance over a period, and the balance sheet is for a specific moment.
Exactly. And remember that accounting equation we talked about? This is where it comes together.
You mean assets equals liabilities plus stockholders' equity. So the balance sheet basically proves this equation is true for that specific moment.
Precisely. The balance sheet lists all the assets on one side, all the liabilities and equity on the other, and guess what? The two sides always balance. That's why it's called the balance sheet.
Like a puzzle that always fits together perfectly. Grade Guru even highlighted that this balance is a fundamental accounting principle. Total assets must always equal total liabilities plus stockholders' equity.
Exactly. And it gives you a snapshot of the company's financial health. Are they loaded with assets? Do they have tons of debt? What's the breakdown of liabilities and equity? The balance sheet gives us all those insights.
This is all making a lot more sense. We've got the income statement, which tells us about profitability over time, and the balance sheet, which gives us a snapshot of a company's financial position at a specific time. What's next?
Next up, we have the statement of cash flows. This one focuses on the movement of cash, both in and out of the company. It gives us a detailed look at how they're generating and using their cash.
Cash flow seems pretty important. Isn't that what keeps a company running?
Absolutely. A company can look profitable on paper, but if they're not managing their cash flow well, they can run into some serious problems. The statement of cash flows helps us understand how they're managing that vital resource.
So how does it break down those different ways cash is flowing?
The statement of cash flows sorts cash flows into three main activities: operating activities, investing activities, and financing activities.
Okay, three categories. What falls under operating activities?
Operating activities are basically the cash flows from the core business operations. Think cash from customers for sales, cash paid to suppliers for inventory, cash for rent, salaries, and other operating expenses. Day-to-day activities that generate revenue and incur expenses.
Got it. The cash flow related to just running the business. What about investing activities? Those sound a bit more long-term.
Investing activities involve buying and selling long-term assets. Buying or selling property, equipment, even investments in other companies, usually related to expanding the business or getting new resources for future growth.
So how the company is investing its cash for the long run? What about the last one, financing activities? Where does that cash come from and go?
Financing activities involve transactions with lenders and investors, borrowing money, like taking out loans, issuing stock, paying back debt, or paying dividends to shareholders. It's all about how the company finances its operations and growth.
Wow, the statement of cash flows breaks down all the different ways cash moves through a company. It's like a map of its cash journey.
Exactly. And by looking at this statement, we can get some real insights into the company's financial health. Are they generating enough cash to cover their expenses? Are they investing wisely? Are they relying too much on debt? The statement of cash flows helps us answer these questions.
Okay, we've covered three of the four financial statements: income statement, balance sheet, and statement of cash flows. What's the last piece?
The final one is the statement of retained earnings. This focuses on retained earnings, which is part of stockholders' equity.
Retained earnings. I remember that. Can you remind me what that is?
Retained earnings are the portion of a company's net income that's kept within the business instead of given to shareholders as dividends. Basically, it's the accumulated profits that the company has reinvested back into its operations over time.
It was like a savings account for the company's profits. They can use those retained earnings to fund their growth, right?
Exactly. And the statement of retained earnings shows us how this amount changes over time. Starts with the beginning balance, adds net income for the period, subtracts any dividends paid to shareholders, and then calculates the ending balance of retained earnings.
A running tally of how much profit they've put back into the business. Great Guru gives a practical example here. They show a company with beginning retained earnings of €5,000, net income of €3,000, and dividends of €1,000. That results in an ending balance of €7,000. They basically added their profit to what they already had and then subtracted what they paid out to shareholders.
Exactly how it works. The statement of retained earnings gives us insights into the company's dividend policy and their overall financial strategy, prioritizing reinvestment, returning profits to shareholders. This statement helps us understand their decisions.
We've covered a lot of ground here. We've looked at the accounting equation, the income statement, the balance sheet, the statement of cash flows, even the statement of retained earnings. It's amazing how these financial statements work together.
Absolutely. Understanding how they connect is crucial for anyone studying accounting. For example, net income from the income statement flows into the statement of retained earnings, and that then impacts the equity section of the balance sheet.
So it's not just about understanding each statement by itself. It's about seeing how they all fit together to tell the company's financial story.
Exactly. With that understanding, you'll be well on your way to mastering accounting.
This has been super helpful. Before we move on, I want to remind everyone that this deep dive is brought to you by Grade Guru. They've provided all this fantastic material we're going over today.
That's right. And for even more practice and resources to ace your accounting exams, head over to gradeguru.nl. Tons of helpful content there, including practice exams and full summaries.
A valuable resource. Okay, on to the next chapter in our Accounting 101 journey.
All right, welcome back to our deep dive into Accounting 101.
I'm excited for this part. We're going to unravel journal entries and T accounts, right?
You got it. These concepts can be a little tricky, but we'll make sure you have a good grasp on them.
Awesome. I'm feeling pretty confident with Grade Guru on our side.
You're in good hands. We'll break it down step by step.
All right, let's start with journal entries then. What are they exactly? And why are they so important in accounting?
Journal entries, well, they're the lifeblood of accounting. It's how we record every single financial transaction a company makes.
So, like, every time money comes in or goes out, every time assets change hands, we create a journal entry for it.
Exactly. Think of them as the first step in the accounting cycle.
So it's like writing a history of the company's financial activities.
That's a great way to put it. Each journal entry tells a story about what happened, financially speaking.
Okay, that makes sense.
For example, let's say a company buys new equipment.
Okay.
We'd make a journal entry to record that transaction.
And those journal entries are what eventually make up those financial statements we were talking about earlier, right?
Yeah, exactly. We take the info from journal entries, summarize it, categorize it, and then use that to prepare the income statement, balance sheet, statement of cash flows, and the statement of retained earnings.
Okay, I'm starting to see how it all fits together, but I'm still a little confused about debits and credits.
I understand. Debits and credits can be tricky for a lot of students.
Yeah, it seems kind of counterintuitive.
It's really not that bad once you get the basics down, I promise.
Okay, so break it down for me. What are debits and credits, and why do we even use them?
Simply put, debits and credits are the two sides of every accounting transaction. It's like a scale, always balanced.
Okay, I like the scale analogy, but how do we know which side to put things on? When do we use debit and when do we use credit?
Well, there are rules for that,
Mm.
and they depend on the type of account we're dealing with.
The account types, you mean like assets, liabilities, equity, revenue, and expenses.
You got it. Each account type has its own rules for debits and credits, and those rules are super important for keeping the accounting equation balanced.
Gotcha. So let's dive into these rules then. Let's start with assets. What's the debit and credit rule for those?
Golden rule for assets is debit to increase, credit to decrease. So if a company buys a new asset, like a delivery van, we debit the asset account, delivery van, to increase it.
So if they sold an asset, like an old computer, we'd credit the asset account, computer equipment, to decrease it.
You got it. See, you're getting it.
Okay, so assets are debit to increase, credit to decrease. Got it. Now what about liabilities?
Liabilities are the opposite of assets. Credit to increase, debit to decrease.
So if a company takes out a loan, we would credit the liability account, loans payable, to increase it. And if they make a payment on the loan, we would debit the liability account to decrease it.
Nailed it. Not so complicated once you know the basics, right?
Okay, I'm feeling more confident already. So we've covered assets and liabilities. What about equity accounts?
Equity accounts follow the same rules as liabilities. Credit to increase, debit to decrease.
So if a company issues new shares of stock, we'd credit the equity account, common stock, to increase it. And if they pay dividends to shareholders, we debit the equity account, retained earnings, to decrease it.
You're a pro at this.
I'm starting to feel like it. Okay, we've done assets, liabilities, and equity. What about the last two, revenue and expenses?
Revenue accounts, they follow the same rule of liabilities. Credit to increase, debit to decrease.
So when a company makes a sale and earns revenue, we credit the revenue account, like sales revenue, to increase it.
Right.
And expenses follow the same rule as assets then. Debit to increase, credit to decrease.
Exactly.
So if they have an expense, like rent or salaries, we would debit the expense account to increase it.
Precisely. You've mastered the rules of debits and credits.
I think it's starting to click.
Yeah.
But how do we actually see these debits and credits in practice? That's where the T accounts come in, right?
Yes. T accounts are like a visual representation of each account, like mini ledgers that show the balance and how it's affected by the debits and credits.
So each T account has a debit side and a credit side, like a T.
Exactly. Account name at the top, debits on the left, credits on the right.
And we use the T accounts to track the changes in each account based on the journal entry.
Yep. Let's say a company buys some office supplies on credit. We would create a journal entry that debits the asset account, office supplies, and credits the liability account, accounts payable.
Okay, and how would that look in the T accounts?
We'd have two T accounts, one for office supplies and one for accounts payable.
And for office supplies, we'd put the debit on the left side, increasing the balance of that asset account.
Exactly. And for accounts payable, we'd record the credit on the right side, increasing that liability account.
I see. So the T accounts give us a visual way to see how each transaction affects the account balances.
Exactly. And this way, we can ensure that the accounting equation always stays balanced.
Okay, this is all starting to make a lot more sense. But how do these T accounts connect to the financial statements?
Great question. The balances in those two accounts, we use those to prepare the trial balance. It's a summary of all the account balances at a certain point in time.
And then the trial balance is what's used to create the financial statement.
You got it. The trial balance makes sure our debits and credits are equal, that the accounting equation is balanced. Then we use the info from there to make the income statement, balance sheet, statement of cash flows, and statement of retained earnings.
Wow. It's amazing how all these little steps, like the journal entries and T accounts, are so important to the big picture.
They're the building blocks of financial reporting. Couldn't do it without them.
I'm feeling way more confident about journal entries and T accounts now, thanks to your explanations. Those Grade Guru examples are really helpful.
You're doing great. Remember, practice makes perfect. The more you work with them, the easier it gets.
And speaking of practice, I want to remind everyone that gradeguru.nl has lots of resources to help practice exams and summaries of all the key concepts.
Absolutely. Don't forget to check it out. It's a great tool for prepping for exams.
Okay, we've covered a lot in this section. From journal entries and debits and credits to T accounts and the trial balance, I'm feeling pretty good about it.
You should. You've made some serious progress.
I'm ready for the final part of our Accounting 101 deep dive. Bring it on. All right, welcome back to our final part of our Accounting 101 deep dive. Feeling like a real accounting whiz now after everything we've learned.
I'm impressed. You've really picked things up quickly, asking all the right questions.
I have to give Grade Guru's materials some credit. They've been really helpful.
Definitely. Speaking of, don't forget to remind our listeners that they can get practice exams and summaries of all this material on gradeguru.nl.
Yes, absolutely. It's an amazing resource for accounting students. Okay, we've talked about the accounting equation, financial statements, journal entries, T accounts, the trial balance. Anything else we absolutely need to know?
Now it's all about putting that knowledge into practice. Let's talk about how to use all of this to analyze a company's financial health.
Ooh, that sounds really useful. What's the point of learning all this if we don't know how to use it?
Exactly. So let's say you're looking at a company's income statement. What are some key things you look for to see how profitable they are?
Well, I know net income is a big one, right?
Mm-hmm.
I'd want to see a good net income, meaning more revenue than expenses.
That's a great start, but it's also important to look at the trends over time. Is the net income going up each year or down? What's the overall pattern?
Right, not just a single snapshot. We want to see how their profitability is changing. Are they getting better or worse at managing things?
Exactly. And another good thing to do is compare a company to others in their industry.
Oh yeah, benchmarking them against their competition.
Right. By comparing key ratios and metrics, you can get some insights into their strengths and weaknesses compared to others.
So like if a company's profit margin is way higher than the industry average, that probably means they're doing something right.
Absolutely. Managing their costs really well, or maybe they have a really special product or service.
That makes sense. Okay, what about the balance sheet then? Any red flags we should look out for there?
Well, remember the debt-to-equity ratio? I'd be a little worried about a company with a really high one.
Because it could mean they're relying too much on borrowed money.
Exactly. Could be risky if interest rates go up or their earnings take a hit.
Gotcha. What else?
Liquidity is important too. You want to make sure a company can meet its short-term obligations, pay its bills and such.
Right, we don't want them going bankrupt.
Exactly. Look for enough cash on hand or assets that can easily be turned into cash.
Makes sense. Okay, and how about the statement of cash flows? What can we learn from that?
That statement is so important for understanding how a company is generating and using its cash. It's a much more dynamic picture than the balance sheet, which is just a snapshot.
We can see the cash coming in and going out over time.
Precisely. And one key thing is to look at whether the company is creating positive cash flow from its main operations.
So if they're consistently bringing in more cash from their day-to-day business than they're spending, that's a good thing, right?
Absolutely. Means they're running a sustainable and profitable business.
What about cash flow from investing activities?
Well, if they're investing in growth, like new equipment or expanding their facilities, that can be a good sign for the future.
It means they're confident and willing to invest, right?
Exactly. But it's important to make sure those investments are smart and strategic.
Don't want them just throwing money around.
It's all about balance.
I feel like I'm learning so much.
Remember, this is just the tip of the iceberg. Financial analysis is complex, but these basic concepts are a great foundation.
This deep dive has been amazing. I feel so much more prepared for those exams now.
Glad to hear it. And remember, practice makes perfect. Keep reviewing those key concepts and doing practice problems.
And everyone listening, don't forget to check out gradeguru.nl for all those resources they provide.
It's a great resource for anyone who wants to learn more about accounting.
Okay, it's time to wrap up our Accounting 101 deep dive. From the accounting equation to financial statements, even getting into some real-world analysis.
It's been a pleasure.
Same here, I've learned a lot from you.
You'll be able to handle any accounting challenge now, I'm sure of it.
And to everyone listening, remember, understanding accounting is a real superpower in business. It helps you see things others might miss and make smart decisions about companies, investments, even your own finances.
Keep learning, keep exploring, and keep diving deep into the world of accounting.
Until next time.